Nathan, always wonderful to see you. Thank you so much for joining us. Abigail pointed out a pretty severe move in yields. When do we see the disastrous shakeout in the markets that everyone's kind of anticipating?
Well, to date, it's been more, I think, reflation, where the run-up in yields has come more or less in sync. And I think this is what Jay Powell told us yesterday. With an improving macroeconomic outlook, we're expecting stronger growth over the next year and likely some higher inflation. And as long as the rate rise is moving in tandem with those underlying macro fundamentals, I think that the broader economy and the market should be able to absorb it. It means we'll have faster growth, and more profits, and stronger balance sheets in line with the stronger economy.
Nathan, good morning. It's Guy. When do you think that the 2 year is going to move then?
So this is the other side of what the Fed is doing, is that on the one hand, the Fed says it wants reflation, but it's also saying that it is willing to hold short-term rates until we are well into that reflationary cycle. And when I talk about this, it's not only reflationary in terms of market expectations, but the Fed wants to see inflation, wants inflation to overshoot. And I think that the markets have taken Jay Powell's commitments as being credible. And markets are not expecting any rate rises over the next couple of years. So all of this is getting loaded into the back end of the curve.
It feels like there are also some technical reasons as well, right? Like we're 1 day from the end of February, so there's repositioning. The supplemental leverage ratio, questions as if that will not come back. And if it does come back, you're going to see some selling from banks potentially, convexity hedging when you have to extend your duration. You have to sell some duration because no one's refinancing their mortgage. Like, how much credence do you play into all those things? Quants are being blamed.
Well, my sense is that those kind of market microstructure technical factors are important on a day-to-day and maybe even a week-to-week basis. But when we look at the broad sweep of rates, they really started to accelerate upward after the Georgia runoff. And what the markets are responding to there is underlying macro fundamentals. And specifically, first, an expectation of much larger stimulus. And secondly, the ongoing progress and apparent success of this vaccination campaign. And both of those are real fundamentals that are likely to drive growth. So we have to be aware of those technical factors, but over time, I think this move at least has been largely explained by what's happening in the economy and specifically what people expect. It's about expectations for economic performance.
Nathan, how much time are you spending watching the data that are coming out from around the world in terms of the vaccination news that we're getting? The data, and we're going to talk about this later on in the program, in terms of Israel, absolutely astounding. Herd immunity, absolutely possible. The data out of Scotland, absolutely positive when it comes to the efficacy of a number of different vaccinations. The data cumulatively from around the world are just getting better and better and better. How much time are you spending on that? And how big a factor is that behind what we're seeing at the moment?
We're following those data very closely. And I think at the end of the day, if you ask me, what is the number one determinant of where the economy will be, the global economy will be in 6 to 12 months, I think it's the success of the global vaccination campaign. And when I look at it as a U.S. citizen, I'm very interested in how those vaccinations are going in the United States. But in addition, I think that we've learned that as long as the coronavirus is present and multiplying in other parts of the world, we're all vulnerable to various mutations and so forth. So that vaccination campaign is critical for global growth, and it is critical for every jurisdiction that all jurisdictions be successful in defeating it.
So how having the reflation trade be that in the U.S., we might be able to handle it because our growth could be huge. Europe is in a very different spot. In terms of inflation, in terms of growth, we've seen some verbal intervention from Lagarde this week, as well as economist Philip Lane, seemingly trying to do some verbal intervention to talk down a ferocious move in yields in Europe, particularly with BTPs as well as in Greek debt. Are they going to have to start getting in there, buying for real?
The situation in Europe is different, as you point out, than in the United States. At a minimum, I think that Madame Lagarde and her colleagues are hoping that this rate run-up in the United States, which is being echoed, but not quite to the same extent in the euro area, takes the heat off the euro. That the last thing that they need in this environment is a strengthening euro. And it may be where they end up is that financial conditions are about where they would have been anyways, but rates are somewhat higher and maybe their currency is a little bit weaker than it was before. But the ECB is in a very difficult place. That economy is softer than in the United States. And the difference in terms of inflation performance is even more profound. And so it doesn't surprise me that Madame Lagarde has been kind of more tepid about the rate hikes than Chairman Powell was in his recent testimony.
Nathan, I just want to turn to the UK. Gilts have seen a huge sell-off over the last few months, generated partly back to that vaccine story we were talking about just a moment ago. Do you think gilts are a buy at this stage? Do you think some of these moves are starting maybe to run out of steam?
The fundamentals there, I think, are a little bit more certainty in that you have a Brexit deal. How all of the implications of that play out, I think, are an open issue. And you also have a very successful vaccination campaign that's ongoing. And I think that has contributed to that rise in gilt rates. But when I look at this move in rates, be it in the UK or in the US Treasury market, it's pretty clear that we're in a place where these fundamentals are likely to continue to drive strong economic performance. So it wouldn't surprise me if in 6 weeks, say, global rates are higher than they are today. But I also expect that over time, this is going to be an exquisite round trip where over the medium term, the global economy, once we get on the other side of this boom and return, that the global economy is going to look and feel a lot like it did pre-pandemic: low rates, low inflation, and moderate growth.